Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, we're going to look at a past paper question that focuses on the concept of depreciation. That question is taken from May 2011, question 3. Part A1 reads, define the term depreciation. So you're asked to state, what is depreciation? Depreciation is the loss in value of a non-current asset over its useful life. So basically, it is a part of the original purchase cost of a fixed asset consumed during its period of use. Part 2 reads, identify the double entry used to record depreciation. And depreciation is an expense, so therefore you're going to debit your income statement, or you could say debit profit and loss account, very same thing, and you're going to credit your provision for depreciation account. State 3 causes of depreciation. So you have to give 3 causes of depreciation. We have physical deterioration, we also have economic factors, where we talk about the item being inadequate or the item being obsolete. That's a fixed asset. When I mention item, we have time factor, and we also have depletion. Now, because it's stated that you're to state, the question asks that you are to state, it means that you're not just going to list them like you're seeing on the screen there. You need to give brief explanation of each. So if, for example, I'm looking at economic factors, economic factor, you would talk about the item being obsolete in the fact that because there's a process of item becoming outdated due to advances in technology. For example, the business might have a computer, and there are rapidly changes in the computer. So you may find that the computer that you had like 2 years ago or 3 years ago may not have any use to the business. So therefore, it becomes obsolete. Okay? In terms of physical deterioration, we're talking about things like wear and tear. Once you start using the item, it is going to start losing its value. So therefore, it starts to depreciate. In terms of physical deterioration, you can look at the fact of that the item may erode. You might look at the fact that the item may rust, rot, and decay. So for example, like metals in motor vehicles, you can talk about that being rust or corroded, right? Or say, for example, you have a furniture in the business, like a desk in the business, and that is made out of board. You might find that the board starts to rot. Eventually, over time, it's going to start to rot. So once you're asked to state, you have to give brief explanation of the item. So those are just 4 factors of depreciation. Now we're going to move into the next part of the question, which is part B, and it reads, Tambourine Company bought equipment costing $80,000 and charged depreciation at a rate of 10% per annum using the reducing balance method. And part I, you're asked to use the table below to complete the first 3 years of the equipment's life. Now you're presented with 3 years, and the columns read cost or net book value before depreciation, depreciation expense for the year, accumulated depreciation, and net book value after depreciation. So you need to complete each column for each year. So we're going to start with the first year, where the cost of the item would be recorded, and that is $80,000. In the first year there, depreciation expense would be the 80,000 multiplied by the 10% rate for depreciation, and that would give you a value of $8,000. So 80,000 times 10% give you $8,000. That is the depreciation expense for the first year. Now, accumulated depreciation means total depreciation to date. And this is the first year where the depreciation is charged. So therefore, what it has depreciated by so far is just $8,000. To get your net book value, it would be the cost minus accumulated depreciation. And in this case, that would be the 80,000 minus the $8,000. And that gave us a value of $72,000. So at the end of the first year, net book value is $72,000. This is what we're going to start the second year with. So the net book value to begin with in the second year is $72,000. That is a value at which the business begin the second year with for equipment. The depreciation, because we're using the reducing balance method, we're going to calculate that rate on the value of the asset to date, which is 72,000 multiplied by the 10%. And that gives us a value of $7,200. We are now at the accumulated depreciation column. And remember, accumulated is total depreciation to date. Accumulated depreciation is total depreciation to date. How much has the equipment depreciated by so far? The first year, it depreciated by $8,000. And now we're seeing where there is an added cost of $7,200. So total depreciation for at the end of the second year is at 8,000 plus 7,200, which gives us $15,200. Now we are at completing the net book value after depreciation column for the second year. And remember, that is cost minus accumulated depreciation, or you could go by way of subtracting the depreciation expense for the second year from the value at which it started with, which is $72,000. If you use cost minus accumulated depreciation, which is 80,000 minus 15,200, or if you use the net book value, which is the value at which the equipment would start the second year with, minus the depreciation expense for that year, you should still get 64,800 as the net book value at the end of the second year. Now, to begin the third year, we're going to start with that net book value, which was at the end of the last year, the second year that is, and that is 64,800. Our next step is to complete the second column, which is depreciation expense for the year, and that is the 64,800 multiplied by 10%, and that gives us $6,480. Our next step is to enter our accumulated depreciation, and there are two ways in which you can do this. You could add up depreciation expense for each year. So that would be 8,000 plus 7,200 plus 6,480. Or you could add a depreciation expense for this year to the total depreciation that was generated at the end of the second year, and you would still get the value of $21,680. So total depreciation to date, which is at the end of the third year, is $21,680. And now we're going to complete the final column. Again, you could go cost minus accumulated depreciation for the third year, or the net book value at the beginning of the third year minus depreciation expense for that year, and that would give you a value of $58,320. So that is the response for part I. The next part to this question is for you to prepare the balance sheet extract for the third year. Balance sheet extract for the third year. In doing your balance sheet, remember, you use the cost column, and the original cost for the fixed asset is $80,000. You would enter in the accumulated depreciation column the $21,680 because that is the total depreciation at the end of the third year. And then you would get your net book value of $58,320. So we're going to record that information in the balance sheet extract. So remember, you need to enter up your title, and it reads Tambering Company balance sheet extract as at year 3 because that's the third year extract because we're not doing a full balance sheet. You have to ensure that you put in the details fixed asset, indicating that the equipment is a fixed asset. So we're going to enter the details equipment because you have to indicate the type of fixed asset that you are showing information for. The cost price of $80,000. The accumulated depreciation at the end of the third year is $21,680. And to get our net book value, that is the cost minus accumulated depreciation, and that gives us a value of $58,320. That is it for May 2011, question 3.
Like, share, and don't forget to subscribe.